Welcome back. I just did something most investors on YouTube won't do. I took the 16 most hyped stocks on the internet, the ones everyone is telling you to buy for 2026, and I audited them using the only sources that actually matter: their SEC filings, 10K reports, and raw balance sheets. The result? The data forced me to throw 6 of them in the trash. These companies are burning cash, drowning in debt, and could wipe you out. But the 10 that survived? These are the monsters that will build wealth. Let's see who made the cut. Grab a notepad because we are going deep today. Let's get into the list. Number 10, Walmart. We are starting with the ultimate safety play, Walmart. Now I know what you're thinking. Retail? That's boring. But in this market, boring is beautiful. While tech stocks can drop 30% in a month on bad news, Walmart is the anchor that keeps your portfolio from drifting away. The moat. Walmart's moat isn't just its size, it's its purchasing power. They are the largest retailer in the world, which gives them monopsony power over suppliers. They can demand the lowest prices on earth, and they pass those savings to customers. This creates a price gap that competitors, even Amazon, struggle to match on groceries. But the real story here is their logistics network. They have a store within 10 miles of 90% of the US population. They are turning these stores into fulfillment centers for same-day delivery, effectively neutralizing Amazon's speed advantage. The 2026 catalyst. Why buy it now? 2 words: advertising revenue. Walmart is quietly turning into a media company. Their ad business, Walmart Connect, allows brands to target you while you shop. This is high-margin revenue. We're talking 70% to 80% margins, compared to the thin 4% margins they make on selling milk. As this ad business grows in 2026, it is going to structurally lift their profitability. The risks. The big risk here is the supply chain. Walmart imports a massive amount of goods. If we see new global tariffs or trade wars in 2026, their input costs go up. However, their scale usually allows them to absorb these shocks better than anyone else. The action plan. So, how do you play this? Think of Walmart as your cash substitute. I personally use Walmart to park capital when I'm nervous about the tech sector. If the economy crashes in 2026, where does the consumer go? They go to Walmart to save money. If the economy booms, Walmart makes money on ads. I look to allocate about 5% to 10% of my portfolio here as a hedge. I am buying on any dips, specifically targeting a price-to-earnings ratio around 22 times. It's not going to make you rich overnight, but it will keep you rich. Number 9. Amazon. Next up, we have the sleeping giant, Amazon. For the last 2 years, Amazon has been in fitness mode. They overexpanded during the pandemic, and the stock went sideways. But that period is over. They have cut costs, slimmed down, and are now a lean, mean cash flow machine. The financial health. Let's look at the hard numbers. Operating income hit $69 billion recently. That is a staggering number. They have effectively refilled their war chest after their heavy spending cycle. They have a dual moat. First, nobody can match their delivery speed. It is simply too expensive for anyone else to build that infrastructure now. Second, AWS, Amazon Web Services. Once an enterprise moves its IT stack to AWS, leaving is a nightmare. High switching costs equal pricing power. The 2026 catalyst. The catalyst for 2026 is the re-acceleration of AWS. For a while, companies were cutting their cloud bills. That's done. Now, companies are rushing to deploy generative AI and they need the cloud to run it. AWS has launched Bedrock and Q, their AI tools, which are starting to monetize. We are seeing AWS growth tick back up toward 20%. And when AWS grows, Amazon's profits explode. The risks. The biggest threat is antitrust. The FTC is actively hunting Amazon. A forced breakup of the company would create chaos in the stock price in the short term, even if the individual parts are worth more. The action plan. Here is my take. Amazon is currently a GARP play, growth at a reasonable price. Unlike Nvidia, which is priced for perfection, Amazon is priced for skepticism. The market still doesn't fully appreciate how profitable their advertising arm is becoming. I view Amazon as a core holding. I am building a position here with a 3 to 5 year time horizon. I am looking for a break above recent highs to confirm the next leg up. If you don't own Amazon, you are betting against the most dominant logistics and cloud company on earth. Don't overthink this one. Number 8. Lam Research. Now let's talk about the chips, but we aren't starting with the famous ones. We are starting with the company that makes the machines, Lam Research. This is what I call a technological oligopoly. The moat. You physically cannot build modern AI chips without Lam's tools. Specifically, you cannot build high bandwidth memory, HBM, without them. HBM is the specialized memory that sits next to every Nvidia GPU. Building it requires stacking silicon wafers 100 layers high with atomic precision. Lam Research dominates the etching and deposition market for this process. It creates a barrier to entry so high that new competitors can't even get funding to try. The financials. This is a highly profitable business. Gross margins are consistently near 50%, and they are extremely shareholder-friendly. They return about 80% of their free cash flow to you via dividends and buybacks. They have a pristine balance sheet that allows them to weather any downturns. The 2026 catalyst. The catalyst is the HBM boom. HBM production is growing 50% annually. Because HBM is harder to make than regular memory, it requires more of Lam's tools. This means Lam is going to make money regardless of whether Nvidia or AMD wins the chip war. They are the arms dealer selling ammo to both sides. The action plan. This is your backdoor AI play. If you are worried that Nvidia is too expensive, you buy Lam Research. It trades at a much lower valuation but captures the same growth trend. However, be warned, it is a cyclical stock. It booms and busts with the memory market. My strategy? I dollar cost average into Lam. I don't chase it when it spikes 10% in a week. I wait for the pullbacks. Watch the book-to-bill ratio in their earnings. As long as that stays above 1.0, the bull run is intact. Number 7. Broadcom. Next is the king of efficiency, Broadcom. Think of Broadcom less as a hardware company and more as a private equity firm disguised as a chip company. Their CEO, Hock Tan, is a legend for a reason. The moat. Broadcom buys companies with sticky, mission-critical technology, like VMware or Symantec, and then aggressively cuts costs while raising prices. This creates a portfolio of franchise assets that customers can't rip out. But the real story for 2026 is custom silicon. Big tech giants like Google and Meta are tired of paying Nvidia's high prices. So they are designing their own internal AI chips, ASICs. Who helps them design and build those chips? Broadcom. The financials. Broadcom is a cash flow monster. They generate 67% operating margins. Let me repeat that, 67%. That is software-level profitability on hardware products. They carry a lot of debt from the VMware acquisition, but their cash flow is so strong that they can pay it down rapidly while still raising their dividend. The action plan. Broadcom is the stock you buy for dividend growth. This is the perfect stock for an IRA or a long-term compounder portfolio. The custom silicon business gives you the AI upside, while the software business gives you stability. I am treating Broadcom as a core anchor in my semiconductor allocation. I am looking for this stock to continue its march upward as the VMware integration completes in 2026. Buy it, reinvest the dividends, and ignore the noise. Quick pause. I'm sketching out the blueprint here, but you need to take action. The market rewards the prepared, not the hesitant. If you want to stay ahead of the curve and catch the next dominator before it takes off, do yourself a favor. Smash that subscribe button and ring the bell. Don't just watch the game, play it. Now, let's get back to the video. Number 6. Advanced micro devices. Then we have the value play, AMD. If Nvidia is the Ferrari, AMD is the Corvette. It offers high performance, but at a price point that corporations can actually afford. The moat. AMD's moat is simple. It is the second source. The entire world is terrified of being 100% dependent on Nvidia. Hyperscalers like Microsoft and Meta need a competitor to keep prices in check. AMD is the only company on Earth capable of producing a GPU that rivals Nvidia's performance. That guarantees them a seat at the table. Their new MI300 chips are gaining traction, and they are taking market share in the inference market, where companies run their AI models after training them. The 2026 catalyst. The catalyst is enterprise inference. In 2026, AI moves from R&D labs to corporate IT departments. Most companies don't need the most expensive Nvidia chip to run a customer service bot. They need something good enough and cost-effective. That is AMD's sweet spot. The risks. The risk here is a price war. If Nvidia decides to lower its prices to crush the competition, AMD's margins could get squeezed. They don't have the same pricing power as Nvidia. The action plan. Here is the trade. AMD is currently priced for skepticism. Its PEG ratio is around 0.47, which implies it is significantly undervalued relative to its growth. If AMD captures just 10% of the data center market, this stock doubles. I position this as a swing trade or a growth satellite. It is more volatile than Nvidia, so I size it smaller, but the upside potential if they execute is massive. Watch the $180 to $200 levels. If we break those, it's off to the races. Number 5. Nvidia. And of course, we have the king, Nvidia. I know people say it's expensive. I know people say the bubble is going to burst. But I have looked at the numbers and the fundamentals say otherwise. The moat. Nvidia's moat isn't just the chips, it's the software. Their CUDA platform has 4 million developers locked in. Switching from Nvidia to AMD isn't just swapping a chip. It involves rewriting code, retraining engineers, and risking downtime. That creates vendor lock-in that is incredibly powerful. They have a 90% market share in data center AI. That is a monopoly. The financials. Revenue is up 69% year over year. Gross margins are in the mid-70s. They have a fortress balance sheet with no net debt. They are generating so much cash they don't know what to do with it, so they are buying back billions in stock. The 2026 catalyst. The launch of the Rubin architecture and Blackwell Ultra chips in 2026. These chips are going to be 10 times more efficient than the current ones. This forces a massive upgrade cycle. Every data center built in 2024 is already becoming obsolete. They have to buy the new stuff to stay competitive. The action plan. So, is it too late to buy Nvidia? No, but you have to change your expectations. It's probably not going to do another 10 times in a year, but it can absolutely compound at 20 to 30% a year from here. I treat Nvidia as the foundation of my portfolio. It is the largest holding. I am not trimming it. I am not selling it. Until I see revenue growth actually slow down, not just rumors, but actual data, I am staying long. The trend is your friend, and this is the strongest trend in history. Number 4. Arista Networks. But here is the thing, chips are useless if you can't connect them. That brings us to Arista Networks. If Nvidia is the brain of AI, Arista is the nervous system. The moat. AI clusters need to move massive amounts of data instantly. If the network lags, the AI breaks. Arista builds the high-speed, low-latency switches that make this possible. Their moat is their EOS software, a single operating system that runs everything. It's programmable, it's reliable, and the cloud titans, Microsoft and Meta, love it. The financials. Arista is arguably the most financially disciplined company on this list. Zero debt, $10 billion in cash, 50% free cash flow margins. These are software-like margins on a hardware product. That's rare. The 2026 catalyst, the shift to Ethernet. Historically, Nvidia pushed its own networking called InfiniBand, but the industry wants an open standard called Ethernet to save money. Arista is the leader in Ethernet. As AI clusters get bigger in 2026, the industry is moving toward Arista's technology. This provides a massive tailwind. The action plan. This is the most under-owned stock in the AI trade. Everyone owns Nvidia, not enough people own Arista. The biggest risk is customer concentration. Microsoft and Meta make up 40% of their revenue. If they sneeze, Arista catches a cold. But given their fortress balance sheet, I am willing to take that risk. I am buying Arista as a long-term compounder. It's a set-it-and-forget-it stock for the next 5 years. Number 3. Palo Alto Networks. Now, what happens when you put all this data in the cloud? Hackers try to steal it. That's why we own Palo Alto Networks. Cybersecurity is no longer optional. With AI, hackers are writing better malware faster. The moat. Palo Alto's strategy is platformization. Most companies have 50 different security vendors. One for email, one for the cloud, one for the network. It's a mess. Palo Alto says, fire them all and just use us. They offer a unified platform that covers everything. This creates high switching costs and makes them the standard of care for Fortune 500 CISOs. The financials. While other cyber stocks like SentinelOne or CrowdStrike can be volatile or unprofitable, Palo Alto is the grown-up in the room. They are GAAP profitable, they generate huge cash flow, and their annual recurring revenue, ARR, is growing at 40%. The action plan. I love this stock because it is recession-proof. If the economy tanks in 2026, companies will fire employees, they will cut marketing, but they will not turn off their firewall. I view Palo Alto as a core growth holding. I am looking for a pullback to the 50-day moving average to add more. As long as cybercrime exists, this company will grow. Number 2. AeroVironment. Let's pivot to something darker but necessary. The world is becoming a more dangerous place. We are seeing conflicts in Europe, the Middle East, and tensions in Asia. And warfare has changed forever. It's all about drones. AeroVironment is the leader in autonomous warfare. The moat. They make the Switchblade loitering munitions, basically suicide drones. These are combat-proven. They are being used in Ukraine right now. That combat-proven stamp is a moat that no startup can replicate. They also acquired a company called Blue Halo to expand into lasers and space warfare. The 2026 Catalyst. The Catalyst is the Replicator Initiative. The U.S. Pentagon knows it cannot match China ship for ship, so they are shifting strategy to build thousands of cheap autonomous drones. This is AeroVironment's entire business model. We are expecting massive government contracts in 2026 as this program ramps up. The action plan. This is a geopolitical hedge. I own this stock because it often goes up when the rest of the market goes down. If a war breaks out, tech stocks tank, but defense stocks rally. However, it is volatile. It depends on government budgets. I size this smaller, maybe 3% of the portfolio, but I hold it tight because the secular trend of drone warfare is just getting started. Number 1. Supermicrocomputer. And finally, the most speculative stock on my list, Supermicrocomputer. I'm ranking this high not because it's the safest, but because it has the most explosive upside potential. But, and listen to me clearly, it also has the highest risk. The business. They build the actual server racks that hold the Nvidia chips. Their advantage is speed. They use a building block architecture that lets them custom build servers faster than Dell or HP. But their real secret weapon is liquid cooling. The new Nvidia chips run incredibly hot. Air cooling doesn't work anymore. You need liquid cooling. Supermicro is the leader in manufacturing these liquid-cooled racks at scale. The risks. Why is it risky? Margins and governance. Their profit margins are thin, around 14%, and they have had accounting issues in the past. This gives the stock a governance discount. The market doesn't trust them fully. The action plan. This is a high-risk/high-reward trade. If they execute on liquid cooling in 2026, this stock could double from here. The valuation is dirt cheap compared to revenue growth. But if they screw up or if Dell steals their market share, it could drop 50%. I treat this as a venture capital bet. I own a small position. I use trailing stop losses to protect myself. Do not bet the farm on this one, but do not ignore it either. So there you have it. The 10 stocks that passed my forensic stress test for 2026. We have the sleep well at night anchors like Walmart and Amazon, the semiconductor dominance of Nvidia, AMD and Lam Research, the cash flow machines Broadcom and Arista, the defenders Palo Alto and AeroVironment, and the Wildcard supermicrocomputer. Investing isn't about guessing, it's about finding the companies with the strongest moats and the healthiest balance sheets, and then having the patience to let them work. I want to hear from you in the comments below. Which one of these 10 is your highest conviction pick for 2026? And which one do you think I'm wrong about? Let's start a debate. If you got value from this deep dive, do me a favor and smash that like button. It helps the channel immensely. Subscribe if you haven't already. I'm watching the markets so you don't have to. I'll see you in the next one.